understand the markets. You study charts, analyze patterns, and follow economic developments. You know what position sizing means. You understand the importance of risk management. On paper, you appear to be a competent trader. Yet many traders with exactly these qualities still destroy their accounts, often suddenly, dramatically, and in ways that seem irrational even to themselves. This contradiction is deeply frustrating. Intelligence, knowledge, and effort should produce success. But in trading, they often do not. The reason is uncomfortable. Markets test behavior, not intelligence. Consider how many skilled professionals struggle when they first begin trading. Engineers, analysts, programmers, and scientists often assume that with enough study, they will master the market. After all, they have solved complex problems before. Initially, this confidence seems justified. They learn technical analysis, understand leverage, study indicators, and develop structured plans. Early successes reinforce the belief that competence has been achieved, but success in trading creates a hidden danger. Confidence begins to shift from the process to the person. Instead of trusting rules, the trader starts trusting judgment. Instead of following a system, decisions become discretionary. Position sizes increase gradually. Stops are adjusted just this once. Trades are taken slightly earlier or slightly later than planned because the trader feels they understand the situation better than the model. Nothing catastrophic happens immediately. In fact, some trades work even better than expected, reinforcing the belief that flexibility is an advantage. But markets are dynamic systems. Conditions change constantly. What worked yesterday may not work tomorrow. Volatility expands and contracts. Liquidity appears and disappears. Correlations strengthen and weaken. When losses begin, the intelligent trader often assumes they can analyze their way out. This is where the real danger begins. Instead of accepting losses as part of statistical variance, they treat them as problems to be solved immediately. Adjustments are made midstream. New rules are introduced impulsively. Risk may increase in an attempt to recover quickly. At this stage, intelligence becomes a liability. The trader can construct logical explanations for almost any action, even reckless ones. Overconfidence and anxiety combine into a powerful emotional force. The trader believes they should be able to fix the situation, yet feels mounting pressure as losses accumulate. This pressure narrows perception. Long-term thinking disappears. The objective shifts from executing a process to restoring the account balance. Recovery becomes more important than discipline. Once this shift occurs, decision quality deteriorates rapidly. Trades are entered not because they meet criteria, but because action feels necessary. Risk limits are ignored because stopping feels unacceptable. The trader is no longer operating strategically. They are reacting emotionally while attempting to justify those reactions intellectually. Ironically, the smarter the trader, the easier it becomes to rationalize dangerous behavior. Eventually, a single oversized loss or a sequence of impulsive trades wipes out a significant portion of the account. Sometimes it wipes out everything. When the emotional storm subsides, clarity returns. The trader often recognizes exactly what went wrong. They knew the rules. They understood the risks. They simply did not follow them. This realization can be devastating because it removes the illusion that knowledge alone guarantees safety. Professional traders avoid this trap not by being smarter, but by being more constrained. They design systems that protect them from themselves. Risk per trade is capped regardless of confidence. Maximum daily loss limits prevent catastrophic spirals. Position sizing is predetermined before the session begins. If limits are reached, trading stops automatically. These constraints function as psychological guardrails. Another crucial difference lies in how success is measured. Professional traders do not evaluate themselves based on short-term profits. They evaluate consistency of execution. A losing trade taken according to plan is acceptable. A winning trade taken impulsively is not. This perspective stabilizes behavior because it removes emotional reinforcement for reckless decisions. Smart traders who blow accounts often lack these stabilizing structures. They rely on judgment alone, assuming intelligence will compensate for emotional volatility. But markets punish inconsistency, not ignorance. Calm discipline applied repeatedly over time will outperform brilliance applied sporadically. There is also a deeper psychological factor at work: identity. Many intelligent individuals are accustomed to solving problems through effort and analysis. When something goes wrong, their instinct is to work harder and think more deeply. In trading, this instinct can be counterproductive. Not every loss is a problem to solve. Some losses are simply the cost of doing business. Trying to eliminate normal losses often leads to excessive intervention, which creates abnormal losses. Another overlooked issue is fatigue. Maintaining focus under financial risk consumes mental energy. As fatigue accumulates, self-control weakens. Decision quality declines, even if the trader remains technically knowledgeable. Late session trades, revenge trades, and impulsive adjustments often occur when cognitive resources are depleted. Professional environments account for this. Institutional traders operate within strict hours, risk limits, and oversight structures. Independent traders often operate without any of these safeguards. Isolation increases vulnerability to emotional swings. Over time, repeated exposure to stress without protective structures makes catastrophic mistakes more likely. If you want to avoid account destruction, the goal is not to become smarter, it is to become more stable. Stability comes from predefined limits, clear procedures, and acceptance of uncertainty. It requires acknowledging that you are not immune to emotional influence, regardless of intelligence. No trader can control outcomes, but every trader can control exposure. The difference between survival and destruction often comes down to a simple principle: protect yourself from your worst decisions, not just your worst predictions. When risk is controlled, mistakes become manageable. When risk is uncontrolled, even correct analysis cannot prevent disaster. Smart traders fail not because they lack knowledge, but because knowledge does not automatically produce disciplined behavior under pressure. True professionalism in trading is not demonstrated by predicting markets accurately. It is demonstrated by maintaining consistent behavior regardless of market conditions. If you can preserve capital during difficult periods, opportunities will eventually return. But if capital is destroyed, skill becomes irrelevant. This is why experienced traders focus obsessively on survival. Profit is a byproduct of survival, not the other way around. If you recognize yourself in this pattern, capable, informed, yet vulnerable to large setbacks, understand that you are not alone. Many traders must confront this phase before developing true discipline. The turning point occurs when you stop trying to prove how smart you are and start building systems that protect you from emotional volatility. If this perspective helped you better understand why even intelligent traders can still blow accounts, consider subscribing to Mindful Trader Lab for more structured guidance on trading psychology, discipline, and professional mindset development. You can also support the channel by liking this video and sharing it with other traders who are working to build consistency and emotional control in the markets. Your support allows this educational content to reach more individuals who are serious about improving not only their strategies, but the way they think, decide, and perform under pressure. Thank you for watching and for investing your time in becoming a more disciplined and self-aware trader.